Why does everyone say that Japan's economy is heading for collapse? As soon as Sanae Takeda took office, the first wave of economic policies she rolled out sent Japan's financial markets into a simultaneous crash of stocks, bonds, and currency. These policies infuriated Donald Trump to no end on the economic front, offended China over the Taiwan question, and even angered both Russia and South Korea at the same time. This new prime minister, highly anticipated by Japan, took just 70 days to push Japan's economy from the ICU straight into the morgue. Today, in this one video, I'll walk you through how Japan's economy under Sanae Takeda is gradually drifting toward ruin. When it comes to Japan's economy, I'm sure the first things that pop into your mind are the lost 2, 3, even 4 decades, the bustling scenes in Japan's red light districts, and the steadily rising price of rice. But today, I'm going to offer you a fresh take. If the United States is the central bank of the world economy, controlling the main valve of the US dollar, the world's reserve currency, then Japan's position in the global economy is more like a commercial bank under the world economic system. It acts as an amplifier for US dollar assets and the ultimate source of global leverage. To understand how this situation came about, we first need to break down Abenomics' 3 arrows policy. These 3 arrows are loose monetary policy, expansionary fiscal policy, and economic structural reform. Of course, we can put it more simply. The central bank prints money, the government hands out money freely, and businesses use this money to invest, hoping that companies will channel these funds back home to stimulate economic growth. You may have noticed that most countries follow a similar policy playbook. But in reality, there's one critical factor: the central bank in normal countries, whether China or the United States, when governments borrow money to drive industrial development. The funds are mostly raised from the private sector. Since the 2008 financial crisis, while the People's Bank of China's balance sheet has kept expanding, its share of GDP has been on a steady decline, from a peak of 64% down to 34% today. The US situation is similar. It hit a high of 36% during the 2022 pandemic, after which the Federal Reserve started shrinking its balance sheet. Today, the Fed's balance sheet accounts for roughly 21% of US GDP. But when you look at Japan's numbers, you'll see what makes it stand out. The Bank of Japan's balance sheet is a staggering 110% of Japan's GDP. This sharp surge in the figure began right after Abe proposed his 3 arrows policy. To put it bluntly, the core of Abenomics' so-called effectiveness lies in printing money. And the consequence of this money printing is straightforward: currency depreciation. When Abe took office in 2012, the USD-JPY exchange rate was around 1 to 75. Today, it has soared to 1 to 156, cutting the yen's value in half. If you look at Japan's GDP denominated in yen since 2012, Abe would indeed seem like a hero for Japan. But switch the currency to US dollars, and you'll find that Abenomics has shrunk Japan's GDP by 30%. The combination of low interest rates and a weak currency hasn't just made the Japanese poorer on the global stage. It has also seriously threatened the quality of life of Japanese residents. Japan's financial market has become a platter of food on the table, freely devoured by international capital. As a result, the carry trade between Japan and the United States has been booming. For over a decade, the global financial industry has thrived on one structural advantage: Japan's near-zero interest rates, which have created the lowest borrowing costs in the world. Whether large institutions, hedge funds, or even many retail investors, they all borrow yen at an ultra-low interest rate of 0.1%, convert it into US dollars or euros, and then buy higher, yielding assets worldwide. For example, US stocks have an average annual return of 8%. European corporate bonds yield 3, 4%, and bonds in other emerging markets typically yield between 6% and 8%. As long as the return is higher than the 0.1% borrowing rate, investors can turn a profit. The Japanese themselves are no exception. Take the Norinchukin Bank, which collapsed after speculating on U.S. Treasury bonds. It used cheap yen loans in Japan to bet on higher-yielding U.S. Treasury bonds, only to crash spectacularly in the end due to excessive leverage. In the end, all Japanese taxpayers had to foot the bill for this huge loss. Another example is Japan's famous Mrs. Watanabe Group. These Japanese housewives also borrow large sums of yen, convert it into U.S. dollars to buy high-yield U.S. Treasury bonds, and rely on the interest spread to supplement their household income. The Federal Reserve, however, had a way to tackle stagflation back in the day, raising interest rates, keeping them high at all costs, curbing inflation first before pursuing growth. It took the U.S. a full 10 years to get through the great stagflation of the 1970s and 1980s with this set of aggressive measures. Yet, as Japan's newly appointed Prime Minister, Sanae Takeda doesn't have this option. On the 19th of November, 2025, news emerged from Japan that Sanae Takeda planned to launch an economic stimulus package. Under the plan, the government would spend an additional 17.7 trillion yen, and together with private sector spending, the total size of the package would reach 42.8 trillion yen. This extra budgetary 17.7 trillion yen would eventually be turned into government bonds, issued by the Takaichi administration to raise funds. If the Bank of Japan refuses to take over these bonds in the end, the supply of government bonds on the market will increase. With the total money supply remaining unchanged, bond prices will fall and yields will rise. The day the news broke, the yield on Japan's 20-year government bonds jumped to 2.8%. This hot potato landed in the Bank of Japan's lap. The central bank was stuck in a dilemma: either maintain zero interest rates and keep buying government bonds, watching people's purchasing power vanish completely, or raise interest rates, but every 1% increase in rates would mean a sharp spike in Japan's future government bond interest payments, pushing the government straight into a debt crisis. In fact, the Bank of Japan already made a choice back in 2024. Back then, it abandoned its yield curve control policy, allowing the yield on 10-year government bonds to float freely. So in August, the central bank raised interest rates for the first time to 0.25%, triggering a brief stock market panic. The Nikkei 225 index dropped by more than 12% at most in a single trading day. But if this incident only affected Japan's own financial market, it would be no more than a storm in a teacup. But do you remember what I said earlier? In the global economy, Japan actually plays the role of a commercial bank. What's the core business of a commercial bank? Lending money to add leverage to the global financial system and economy. Precisely because Japan's interest rates are low enough and the yen keeps depreciating, borrowing yen to convert into US dollars, then repaying the yen loan after making profits not only costs almost nothing in interest, but also lets investors profit from the yen's depreciation. By current estimates, the total size of yen-denominated carry trades ranges from 15 to 20 trillion US dollars. That's equivalent to 70% of US GDP and accounts for 1/5 of global financial assets. Data from the Bank for International Settlements shows that by 2024, the scale of cross-border direct yen loans had exceeded 4 trillion US dollars. But in reality, after converting this yen into US dollars, a series of leveraged operations follow, including derivatives trading, structured product investments, and various leveraged positions. Just like the Norinchukin Bank's U.S. Treasury bond fiasco I mentioned earlier, it stumbled only after converting yen into U.S. dollars and then piling on more leverage to speculate on U.S. Treasury bonds. So in reality, the total value of U.S. dollar assets backed by yen far exceeds the official statistics from the Bank for International Settlements. From July to August 2024, Japan's interest rate hike at that time not only caused a sharp drop in Japanese stocks, but also led to a 13% fall in the Nasdaq index from mid-July to August. But this was just a dress rehearsal for the collapse of carry trades. If the yen is raised further, the two pillars of carry trades will collapse completely. On one hand, the US will most likely enter an interest rate cutting cycle, while Japan is raising rates. Caught between a rate cut and a rate hike, the arbitrage space for carry trades will shrink drastically, becoming totally unattractive at that point. A large amount of capital will be converted back into yen to repay loans. And this conversion process will in turn push up the yen's value. Changes in the exchange rate will further erode the profits of carry trades, triggering even more capital to flow back to Japan from the US. Keep in mind that 1/5 of global financial assets are based on the yen. This is like building a skyscraper on sand. So if this scenario really plays out, Donald Trump might even rush straight from Washington to Tokyo and use his signature tactics to force the Bank of Japan to cut interest rates. So at that point, what happens if the Bank of Japan insists on not cutting rates? Hyperinflation will drag the Japanese government step by step toward a slow death. That's all for today's video. If you enjoy my content, please follow my channel. In the next video, I'll continue to take you through an in-depth analysis of national economies and uncover the elaborate schemes of politics and capital. Thank you very much.